Most beginner traders lose money in options trading because nobody explains it the right way. They jump into trades, buy random contracts, and hope to get rich overnight. Sometimes they turn $100 into $1,000, but most of the time, they lose everything. In this video, I'm going to show you exactly how options trading works in 2026. You'll learn what calls and puts are, how weekly options work, the best beginner strategies, and most importantly, how to avoid losing money. By the end of this video, you'll understand options better than most beginner traders online. Let's get started. 1. What are options? Options are contracts that give traders the right to buy or sell a stock at a specific price before a certain date. There are two main types of options: calls and puts. A call option makes money when the stock price goes up. A put option makes money when the stock price goes down. Think of options like placing a bet on the future direction of a stock. For example, let's say Apple stock is trading at $200. If you believe Apple will go higher, you could buy a call option. If Apple rises to $220, your option could increase massively in value. That's the power of leverage. But leverage works both ways. If the stock moves against you, your option can lose value very quickly. That's why understanding risk is everything in options trading. 2. Call versus put. A call option is bullish. That means you believe the stock price will rise. A put option is bearish. That means you believe the stock price will fall. Here's a simple example. Imagine Tesla stock is trading at $300. You buy a call option expecting Tesla to rise. If Tesla jumps to $320, your call option gains value. Now let's flip it. You think Tesla will crash. Instead of buying a call, you buy a put option. If Tesla falls to $280, your put option increases in value. This is why traders love options. You can profit in both bull markets and bear markets. But timing matters, because options lose value over time.
3. Theta decay and time value. One of the biggest reasons beginners lose money is because of something called theta decay. Theta is time decay. Every single day, your option loses value as expiration gets closer. Even if the stock barely moves, your contract can still lose money. That's why buying random weekly options is dangerous. Many beginners think this option is cheap, so it must be a good deal. Wrong. Cheap options are usually cheap for a reason. Most of them expire worthless. Professional traders understand probability and time. Beginners chase lottery tickets. And that's exactly why most traders fail. 4. Biggest beginner mistakes. Let's talk about the biggest mistakes beginners make. Mistake number 1, trading with emotion. Fear and greed destroy accounts. Mistake number 2, using too much money on one trade. Never risk your entire account on one position. Mistake number 3, buying options right before earnings. Volatility can crush option prices instantly. Mistake number 4, no stop loss. You must know your exit before entering a trade. And mistake number 5, trying to get rich fast. Consistency beats gambling. Professional traders focus on survival first, profits second. 5. Best strategy for small accounts. If you're starting with a small account, keep things simple. One of the best beginner strategies is buying long calls on strong stocks during uptrends. Why? Because your maximum loss is limited to the premium you paid. That means risk is defined. For example, you buy a call option for $100. The most you can lose is $100, but your upside could be much larger. This makes long calls easier for beginners to manage compared to advanced strategies. Focus on quality setups. Don't force trades every day. 6. Weekly options strategy. Weekly options are extremely popular because they move fast. They can produce huge gains in a short amount of time, but they can also destroy accounts quickly. One beginner-friendly strategy is called the bull call spread. This strategy reduces cost and risk. Here's how it works. You buy one call option and sell another call option at a higher strike price. This lowers the total cost of the trade. It also limits risk.
The trade-off is that profits are capped. But for beginners, controlled risk is far more important than unlimited profit potential. 7. Risk management. This section is the most important part of the video. Risk management. Without risk management, no strategy works long-term. Professional traders usually risk only 1 to 2% of their account per trade. That means one bad trade won't destroy them. You should never revenge trade. You should never double down emotionally, and you should never trade money you cannot afford to lose. The goal is consistency. Small wins compound over time. That's how real traders survive. 8. Live trade example. Let's walk through a simple trade example. Imagine Nvidia is breaking out above resistance. Volume is increasing, momentum looks strong. You decide to buy a call option expiring next week. You choose a strike price slightly above the current stock price. Before entering the trade, you define your risk. You decide if the contract loses 30%, you exit. If the stock continues higher, you hold and trail profits. This is how disciplined traders think. Everything is planned before entering the market. Options trading can be powerful, but only if you respect risk. Today you learned how calls and puts work, why theta decay matters, how weekly options behave, and how to manage risk like a professional. If you found this video helpful, subscribe for more trading content. And comment below, call or put. Thanks for watching, and I'll see you in the next video.